Good. Let's do Bootbusters. It's a very, very good question. It combines PPE and incomplete records very, very good. So this is really very, very good exercise in order to see whether you understand what we're busy with. Bootbusters is an entity that specializes in the sale of rubber boots manufactured with specific rubber that can only be acquired in South Africa. The owner, Mr. Robuster, is a creative entrepreneur who trades as a sole trader. During the past few years, Bootbuster has established a good reputation and has formed close ties with related debtors and creditors. Bootbuster is not registered for VAT purposes. Whoopie. Mr. Buster is not a game bookkeeper and his financial records are incomplete. He sent you the following email. Dear accountant, I hope all is well. Yesterday I received an e-filing notification stating that I need to submit financial statements to SARS. I haven't had time to compile financial statements and I'm quite in a pickle. I wonder if you will be able to assist me in compiling my financial statements. I'm willing to make it worth your while. I have attached the financial information that I have available. I hope you will be able to assist me with the information provided. Good. And then he says the following PDF attachments were available, and by now you should be quite familiar with PDF attachments. Receipts and payments for the year ended 29 February 2016. Receipts and payments. And then he says statement of financial position as at 28 February 2015. 2016, 2015, i.e. as the beginning of the current financial year. And then the notes to the financial statements for the year ended 28 February 2015, where they explain some of these figures in the statement of financial position and obviously also relating to the previous financial period. They give us additional notes, and the first one is basically on equipment and machinery. The second note is all about land and buildings. The third note is all about vehicles. The fourth note is all transactions that relate to debtors. The fifth note is the transactions that relate to creditors. And then 6, 7, 8, and 9 is all to do with other trade payables. So if you look at 6, it is all about insurance. 7 is all about advertisements. 8 is all about internet costs. 9 is the rental, so it's all about the rental agreement. And 10 is about the physical stock take. So the physical stock take as at 29 February 2016, year end, and that was a value of 135,000 Rand. Good. Required from us. Number 1, the IAS 16 note, PPE note, as for the current year ended 29 February 2016. Then the trade and other payables note as of 29 February 2016, and the debtors control account in the general ledger as for the year ended 29 February 2016. So as the question is structured, the question is structured to do PPE first. So let's do the IAS 16 now. Bootbusters owns the following equipment and machinery. On 1 March 2015, the beginning of the current financial year, Bootbusters owned equipment in the form of a computer. The computer was purchased on 31 August 2013. It is depreciated at 10% per annum on the straight line basis. The estimated residual value was estimated to be 1,000 Rand. So what it tells you is in this statement of financial position, here we had equipment at carrying value 14,600. And according to the question, we still have that equipment on hand. And in order to complete the IAS 16 note, what do we need? We need the cost price and the accumulated depreciation as the beginning of the year, i.e. the carrying value as at the beginning of the year. And here we have the carrying value as at the beginning of the year of 14,600. So what we have to do is we have to do the split between cost price and accumulated depreciation. Also, we will have to work out the current year's depreciation because that is part of the movements for the year. And then lastly, we will have to show the carrying value of this asset at the end of the year, also split into cost price and accumulated depreciation. So because we only have the carry value there, we do not have the split between cost and accumulated depreciation, but we have more than enough information to work out what the cost price was as at the beginning of the year. Now, they tell us that the carrying value was 14,600. What is carrying value equal to? That equals cost less accumulated depreciation. And that equals 14,600. Now, what is accumulated depreciation? Accumulated depreciation is cost, which is X, less the estimated residual value of 1,000 Rand, divided or multiplied by 0.1 or divided by 10. And that is multiplied by the number of months since the acquisition date of this asset up to the beginning of the current financial year. So from 31 August 2013 to 1 March 2015, a period of 18 months has gone by already. So now we can work out what the cost price of the asset was. We say, well, the cost price less accumulated depreciation equals 14,600 Rand as at 28 February 2015. Cost price is X, we don't know what it is, less the accumulated depreciation, which is cost X, less the estimated residual value of 1,000 Rand, divided by 10 years, the estimated lifetime of the asset, multiplied by the number of months that has gone by since the acquisition date of the asset up to the beginning of the current financial year, which is 18 months. Now, if we write down the formula like this and you resolve X, grade 3 accounting, accounting maths, then X equals 17,000. So the cost price of the asset was 17,000. To work out the current year's depreciation is now putting on pi because the cost less the estimated residual value, 17 less 1, divided by 10, that will give us our annual depreciation of 1,600 Rand. So, going to the IAS 16 note, for every class of asset, you will have a separate column. Remember, if there are components, like we have a boat that has a body, or the boat itself and an engine, and they've got different life expectancies, you do your calculations for the components separately, but when you do the IAS 16 note, you add the components together. There's no components in this question, so therefore equipment will be the cost price of the equipment of the computer that we've just worked out, the 17,000. They told us the carrying value at the beginning of the year was 14,600. So there's the carrying value, therefore the accumulated depreciation must be 2,400. We've worked out our current year's depreciation charge is 1,600. That was the only movement that took place in the current financial period. So at the end of the year, we still have the computer and the accumulated depreciation would be the 2,400 plus the 1,600, which gives us 4,000 Rand, which leaves us with a carrying value of 13,000 on the computer at the end of the year. Then they tell us that a new machine was purchased during the year. It was decided that the machine should be depreciated on the production unit method. It was estimated that a total of 5,000 units can be produced by the machine over its economic useful lifetime. So the total capacity of this machine will be 5,000 units. For the year ended 28 February 2016, so for the current financial year, we have actually produced 945 units. So what are we going to do? We need the cost price of the asset, less the estimated residual value, which is 0 in this case. Cost price of the asset that also gave us under payments, machinery purchased at 30 November 2015, and the total cost price of that machine was 10,000 Rand. So the cost price equals 10,000 Rand divided by the capacity of 5,000 Rand. That will mean we are going to write off 2 Rand worth of depreciation on every unit that this machine is going to produce. And in this year, we have produced 945 units. So therefore, Our depreciation, we said, is going to be the 10,000 depreciable value divided by the 5,000 total capacity equals 2 Rand per unit, multiplied by the 945 units in this year, which gives us total depreciation of 1890. Going back to our IAS 60 note, in the beginning of the year, there was nothing. We purchased a new machine. The additions at cost was 10,000. Our accumulated depreciation will be our depreciation charge for the year of 1890. So at the end of the year, we will have this machine, cost price 10,000, accumulated depreciation 1890 with a carrying value of 8110. Right, then number 2. Land and buildings are situated in Brixton Stand X1788. They are not depreciated. Payments relating to buildings are made up as follows. Repairs to the shade nets in the parking area, 5,000 Rand. And then due to the increasing number of staff, additional administrative offices were erected to the existing building, 182,000 Rand. When you go to your cash book, on the receipt side, you see insurance company payout note number 6, 45,000 Rand. So let's check note number 6. The insurance company paid out 45,000 Rand after a storm destroyed the shading nets in the parking lot. Refer to note number 2. So, we have paid 50,000 Rand to have the shade nets repaired. We received 45,000 Rand for the loss incurred. So therefore, out of our own pocket, the loss, which is an operating loss, is 5,000 Rand. And that 5,000 Rand, guys, will be shown in the income statement as an expense item for the year. These shade nets, this 50,000 Rand that we have spent, did not increase the value of our asset with 50,000 Rand. It did not increase the value of our asset at all because there was shade nets in the past and there's still shade nets now, and we have just done some repair work on the shade nets. So repairs and maintenance, which does not enhance the value of the original asset, you are not allowed to capitalize. But opposing to that, we have erected an additional admin building. Now that admin building obviously is a new building that we didn't have before, and obviously that will be an asset out of which we're going to receive future economic inflow of resources. So therefore that 182,000 needs to be capitalized. We also see here that land and buildings are not depreciated. So if we go back to our last year's statement of financial position, we have land and buildings at carrying value of 800,000, but that carrying value can only be the cost price because there is no depreciation on the land and buildings. So at the beginning of the year, 800,000, no accumulated depreciation gave us a carrying value at the beginning of the year of 800,000. We are only allowed to capitalize the cost of the admin building erected, which is 182,000. So at the year end, our total cost price will be the 800 plus the 182 equals 982, no depreciation charge, which will leave us with a carrying value at the end of the year of 982,000. Remember, for land and buildings, we also have to write a note to tell the reader where this land and buildings are situated, as well as if this land and buildings was actually pledged as security against a loan, you should mention that fact, and you should make cross-reference to the note where the long-term loan is actually being discussed in. In this case, no such thing, but we have to write down what land and buildings, where are they situated. Land and buildings are situated in Brixton, Stand 1, X1788. Right, so that takes care of land and buildings. Now, number 3 is all about vehicles. Vehicles consist of 2 vehicles, being delivery vehicles. One of the 2 delivery vehicles was traded in on 30 June 2015. Both the vehicles were purchased on 1 March 2014 at the same cost per vehicle. So it's 2 identical vehicles purchased at the same date. It is the policy to depreciate vehicles by applying the reducing balance method at 20% per annum. no residual value applies. Guys, if they gave you residual values, remember it's a reducing balance method, so you are not going to deduct the residual value from the cost price in order to determine the depreciable amount. With the reducing balance method, we work out the 20% per annum on the carrying value of the asset as at the beginning of the current financial year that you're busy with. The vehicle that was sold had an accumulated depreciation of 28,000 Rand on 1 March 2015, the beginning of the year. I only had 2 vehicles. They were identical vehicles. If the accumulated depreciation on the one vehicle was 28,000, it must have been 28,000 on the other vehicle as well. So that means in total, in the beginning of the year, we had accumulated depreciation of 56,000 Rand. So if we look at our vehicles at carrying value at the beginning of the year of 224,000 cost less accumulated depreciation, and we now have the accumulated depreciation of 56,000 Rand, we can add back the accumulated depreciation to derive at the cost price of the asset as at the beginning of the year. So the cost price, 224 plus 56, must give you then 280,000. So each vehicle has costed us 140,000, and each vehicle had accumulated depreciation at the beginning of the year of 28,000 Rand. The one vehicle we kept, the other one we've traded in on 30 June. So we have to work out depreciation on one vehicle that we have actually sold for a period of 4 months, and the other vehicle that we still have for a whole period of 12 months for the year. Then it was traded in on a new delivery vehicle with a cost price of 130,000. So obviously we need to work out the depreciation on the 130,000 as well. So what do we need for our IAS 16 note? We need cost accumulated depreciation in the beginning of the year. We need our movements for the year, additions at cost price, disposals at carrying value, so that we have to determine, and our total depreciation charge for the year. So if we're going to have a look at this, we say, well, accumulated depreciation of the vehicle traded in the beginning of the year was 28,000. We had 2 identical vehicles, total accumulated depreciation 56,000. So the carrying value at the beginning of the year of the vehicles was 224. They gave it to us. So the cost price must have been 224 plus the 56, which gives us 280,000. So each and every vehicle, 224,000, had a carrying value of 112,000 Rand at the beginning of the year. So we have to determine or work out our depreciation on the carrying value. So on the vehicle that we've sold that vehicle on 30 June 2015. It is 112,000 multiplied by 20%, multiplied by 4 months, the period that we've used it. So the depreciation charge on that vehicle was 7,467. What was the carrying value of the vehicle that we've sold? Well, it was the carrying value at the beginning of the year, less the current year's depreciation of 7,467. So the carrying value of the vehicle sold, disposed of, was 104,533. So I have that figure and I can go and plot it on my IAS 16 note, 104,533. We can also insert these values because we have now calculated them. We know that the cost price was 280, total accumulated depreciation 56, gave us the carrying value of 224,000 as at the beginning of the year. We also know that the new vehicle that we've acquired, the cost price there was 130,000. All we have to work out now is the total depreciation charge. So on the vehicle that we had at the beginning of the year and still have now, the carrying value in the beginning of the year of that vehicle was 112,000, multiplied by 20% gives us total depreciation of 22,400. So accumulated depreciation on that specific vehicle would have been the 28,000 as the beginning of the year plus the 22,400, which gives us 50,400. So the net carrying value would have been the 112,000 less 22,400, 89,600, Or alternatively 240,000 less 50,400, which would have brought it back to 89,600 as well. The cost price of the new vehicle was 130,000. We've used it for a period of 8 months. So 130,000 times 20% multiplied by 8 months gives us total depreciation of 17,333. So our total depreciation for the year would have been that 7,467 plus that 22,400 plus that 17,333, which gives us in total 47,200. So now we can actually plot that 47,200. What is our net carrying value, just calculation-wise, to make sure that our IAS 16 note is correct? Well, the one vehicle, the one that we had in the beginning of the year and still have, has a carrying value of 89,600. The new vehicle has a carrying value of 130,000 less 17,333, which is 112,667. So 89,600 plus 112,667 gives us a carrying value at the end of the year of 202,267. So if we go back to this note, we say, well, we must make sure if we take the 224,000 less 47,200 less 104,533 plus 130,000, we must come back to 202,267. The cost price of the vehicles, 270,000, is the new one of 130,000 plus the old vehicle, 50% of the 280 is 140,000, and that gives us a total cost of 270,000. Accumulated depreciation, that we've said is going to be the 28,000 on which it was previously on the vehicle that we still have, plus the 22,400 plus the 17,333 on the new vehicle, which gives us in total 67,733. If I subtract that from the 270,000, voila, I'm back at 202,267. So that's the end of the IAS 16 note. The next section is all about debtors, and they've asked us to do the debtors control account in the general ledger. Now, it is the policy of Bootbuster to allow a 2% discount on all credit sales. If accounts are settled within 30 days after invoice date, all debtors made use of early settlement discount offered unless otherwise stated. So you can assume that when we record a sales transaction, all those debtors will make use of the 2% settlement discount. Then they give us a balance of the allowance for credit losses on 1 March 2015, the beginning of the year, and they tell us that that amount equals an amount of 5,000 Rand. And they give us the balance for the allowance for settlement discount on 1 March 2015, again in the beginning of the year, and they tell us that that balance was 788 Rand. If we go to our statement of financial position as at 28 February 2015, we have trade and other receivables 28,000, but please take care that there's a note number 4. So you have to go to the note, and here's the note. Net trade debtors was 25,000 Rand. And then there was rent paid in advance of 3,000, and that made up the 28,000. So the debtors control account only relates to the 25,000, but important words, that is my net trade debtors. So what are we interested in? We want a gross debtors figure. So we will have to take the 25,000 and add to the 25,000 the balance of the allowance for credit losses of 5,000 and add to that amount the balance of the allowance for settlement account of 788 Rand. So if we go to our debtors control account, our opening balance would be the 25 plus the 5,000 plus the 788, a total of 30,788. Then number 4.4. The bank statement for February 2016 reflected checks referred back to drawer which were received from debtors amounting to 8,200 Rand. So these checks are dead. They didn't go through the bank. We have deposited initially and then there was insufficient funds, so those checks could not have been honoured. They say 5,000 Rand of the 8,200 Rand represents a payment received from a debtor, Mr. Pollock. Mr. Pollock did pay in time in order to qualify for the settlement discount. So this 5,000 Rand that he paid was not equal to 100% of his outstanding debt because he actually took a 2% settlement discount. That 5,000 then only represents 98% of his outstanding debt. So if we want to reinstate his account, we must reinstate his account with the full 100,000 Rand, 100%. Mr. Pollock did pay in time. The cheque received from him was returned by the bank and marked as insufficient funds. Mr. Buster decided that Mr. Pollock will not qualify for any settlement discount in the future. So that means initially we would have created an allowance for settlement discount. He would have paid his outstanding debt. He would have taken the 2%. We would have cleaned out the 2% allowance for settlement discount when we received this cheque initially. But now we cannot reinstate the allowance for settlement discount because he's not going to be entitled on a settlement discount again. So therefore we have to correct our sales figure with a settlement discount amount. So for the 5,000 RD cheque, we credited bank with 5,000 Rand and we have to debit the debtors control with 5,000 Rand, which is only 98% of his outstanding balance of debt. So if we take the 5,000 Rand, we gross it up to 100%, and then we multiply it by 2%. That is the adjustment against our sales, 102 Rand. Our sales was in actual fact understated with 102 Rand, so we're going to credit sales. Remember, we only took 98% of the VAT exclusive amount. There's no VAT here, so only 98% of the invoice value to the sales account. Now he's not going to be able to utilize the 2% settlement discount, and therefore we have to increase the sales to 100% of sales value. Right, now the remaining balance of 8,200 Rand. Guys, what's the remaining balance now equal to? 8,200 less 5,000 equals 3,200 Rand. So that 3,200 Rand was received from another debtor, Mrs. Clifton. Her account has been in arrears for several months, and it was decided that her account must be written off. She forfeited the settlement discount on 17 May 2015, long time ago. And the bookkeeper has already reversed the allowance for settlement discount relating to Mrs. Clifton's account. So initially when she paid the 3,200 Rand, that was 100% of her outstanding debt. So what did we do? We debited bank and we credited debtors. Now the cheque are debt. So the first thing that has to happen is that we have to reverse the initial transaction where we've recognized the payment made by Mrs. Clifton. In order to do so, we're going to credit bank with 3,200 and debit the debtors control account with the 3,200 Rand. Simultaneously, we have decided to write off her account. Now, what is now the actual balance on her account? The actual balance on her account will be the 3,200 Rand that we have reinstated now. So that we're going to write off as a credit loss. So we're going to credit debtors control 3,200 and we're going to debit the expense account 3,200. Now, before we're going to bail out of the debtors control account, let's have a look how much have we received from our debtors for the year. We have received from our debtors an amount of 400,000. But what did we receive? We only received 98% of the outstanding debt. So the first transaction will be bank debit 400,000, debtors control credit 400,000. And then we have to wipe out the outstanding debt completely. So therefore, when we actually did the sales transaction initially, we have created the allowance for settlement discount account. So when payment took place, we took out the allowance for settlement discount, which is another 2%, which was still remaining as an outstanding balance on those debtors accounts. So we must remember to take that out of the books as well. So 400,000 equal only 98% of the outstanding debt. So now we have 100% if we divide it by 0.98. So if we have 100% multiplied by 2%, we will see that the allowance for settlement discount granted on these amounts that we've received must have been 8163 for the year. Now, again, if we go back to receipts, they tell us that cash sales receipts amounted to 188,000 Rand. And that cash sales receipts equals 20% of total sales. So therefore, by implication, 80% of the total sales must then be credit sales. It can either be credit or cash, can't be anything else. So if I have 188,000 and that represents 20% of the total sales, I can take the 188,000 divided by 20%, and that will give me now the 100% of sales. And then I take that amount and I multiply that by 80%, and that will give me my credit sales. So 188,000 divided by 20% multiplied by 80% will give you my credit sales for the year, and credit sales are actually being posted to my debtors control account, and that gives us a total of 752,000 Rand. Now we're done with our debtors control account, and we can work out what's the closing balance, and the closing balance on this account is 368,429. The other part of the question wants you to do the trade and other payables note to the statement of financial position. So all the additional information relating to creditors is the notes 5 up to 10. I see 10 or 11, 10. Good. So let's then start with our opening balances. And our opening balances, if you look at the statement of financial position, trade and other payables, 87,800, but there's a note that explains that amount, 87,800. So if you go to our note on trade and other payables, we see here that creditors was 85,000 Rand. The rest of the 87,800 was made up by advertisements payable, accrued expenses, internet cost payable, also accrued expenses. So therefore, that means that the actual opening balance of our creditors account was 85,000 Rand. Now we also know that hand in hand with creditors is inventory. So let's start with creditors, opening balance 85,000 Rand, and then we're going to do our inventory. Inventory here in our previous year statement of financial position, trading stock, and there's note number 10, 220,000, and if we go to note number 10, it's all about the stock take that took place. So opening balance was 220,000 Rand for inventory. Let's just read note number 10. A physical stock take was done at year end and by applying the first in first out method. The inventory value was determined to be 135,000. Shortly after the inventory count was done, it was established that 25% of the inventory had a defect and that the estimated selling price of the 25% inventory figure was 11,250. So there's an NRV adjustment in inventory. What is very important with these type of questions, that I cannot post the NRV adjustment before I haven't completed all the entries for the year in the inventory account. Now remember, NRV adjustment is an internally generated entry. And that entry can never have an impact with the value of purchases for the year or the value of cost of sales, actual cost of sales, goods sold during the year. So what I have to do when there's an NRV adjustment and I have to do incomplete records, I'm going to complete my inventory account first. Then I'm going to get the closing balance, and there's our closing balance, 135,000, the value of the inventory stock take. So I will have 135,000 Rand there. Then I will post the NRV adjustment, and then I will get the final figure of my inventory, which I will record in my statement of financial position as at year end. So let's do the other entries relating to creditors. A new creditors clerk was appointed during the year. Due to inexperience, payments to creditors were not made on time, and due to these late payments, interest amounting to 1,210 was raised by concerned creditors. So that 1210, I debited an interest expense account and I have credited my creditors account with 1210. Interest 1210, it increased the outstanding creditors balance. All purchases relating to inventory were made on credit. So everything there, that direct link between the inventory and the creditors account. Cost of sales for the year amounted to 264,386. So in my inventory account on the credit side, there is our cost of sales 264,386. Then at year end, a creditors I've missed that one. During the year, stationery to the value of 1770 was purchased on credit. So what was our accounting entry? We debited stationery with 1770 and we credited our creditors stationery with 1770. At year end, a creditors reconciliation was performed and it came to light that a credit note issued by a supplier was never recorded. The invoice price before 5% discount amounted to 1680. So our creditors account has to be reduced with a value of 95% after the deduction of the trade discount, multiplied by 1680, 1596, and our inventory was also correspondingly reduced with the amount of 1596. Creditors 1596. So now if we're going to balance off our inventory account, on the debit side we are going to miss an entry, a balancing figure. And that balancing figure will be our credit purchases for the year. So that 180980 will go to creditors 180980. Right, then we are done with our creditors. We have got all this information, so we can now determine what was the closing balance of our trade creditors, 115,596. In our note, trade and other payables, we can now insert trade creditors, 115,596. So can you see, without completing the inventory account, I could not have been able to complete the creditors account. So I had to do that in order to derive at that balance of 115,596. We've done 6, number 7. Advertisements in arrears at year end amounted to 550 Rand. Now that's an easy one. So with our trade and other payables, accrued expenses advertisements, 550 Rand. The internet cost amounts to 900 Rand per month for the year. Now, how much was our expense for the year? Our expense for the year would be equal to the amount of, oopsie, that is a mistake. Let me just get this thing back. That would have amounted to an amount of 900 Rand per month times 12 months, and that gives us 10,800 Rand expense. If we go back here, we said here we had in the beginning of the year internet cost payable of 2,000 Rand. What is it? It was a liability. So it had an opening balance on the credit side of 2,000 Rand. What happens in the beginning of the year? I take internet, all accrued expenses, prepaid expenses, accrued income, income received in advance, and then I clean it out against the corresponding income or expense account. So in this case, I would have debited the accrued expense account and I would have credited the expense account with 2,000 Rand. Then also here we have paid during the year an amount of 9,600 Rand. Now the easiest way of doing these kind of things is do a little T account. We said, well, we had an opening balance which we've transferred to the expense account. We debited the accrued expenses, we credited the internet expense account, 2,000 Rand. We have paid 9,600 Rand, so we credited bank and we debited the expense account with the amounts paid, 9,600 Rand. Then we said, well, we know that the amount that was closed off against our income statement, our profit and loss account at the end of the year, equaled this 900 Rand times 12. That is the actual expense for the year, 10,800 Rand. So the amount that is the balancing figure in this account, 3,200 Rand, I'm going to debit this expense account in order to balance it off, and I'm going to credit accrued expenses, 3,200 Rand. So internet costs payable at the year end, 3,200 Rand. Right, then the rental for January and February is still outstanding. The rental contract commenced on 1 March 2013. The contract requires that rental escalates by 50% in January of each year. Now for rental, we have paid rent in advance of 3,000 Rand in the beginning of the year, and that was our opening balance. Prepaid expenses got a debit balance, so what do we do in the first day of the year? We would have credited prepaid expenses and debited the rent expense account with 3,000 Rand. Then we have paid rent in actual fact during the year, and the amount that we've paid in rent was this amount of 5,600 Rand. So we credited bank and we debited the expense account once more with 5,600 Rand. Now, what we have to do is we have to find out how much is still, well, we know that there are still 2 months of rent outstanding at the end of the year. So those amounts that we've paid, as well as the amount of the prepaid rent, that constitutes actually the total rent for the year. Now, the rent, sorry, not there, yeah, 5,600 Rand payment plus the amount paid in advance for the year gives us 8,600 Rand in total payment for what period? Period from March to end of December. So for a period of 10 months. So that then means that we have paid for this year up to the end of December 860 Rand per month. There was an escalation of 15%. So the rent for January and February is the 860 times 1.15, which gives us 989 Rand per month. We are in arrears for 2 months. So 989 times 2 gives us a total amount in arrears of 1978. So also accrued expenses, rental in arrears, 1978. Now if we add everything together, total trade and other payables, 121,324. So that is the end of this question.